Welcome back, everyone, to the Exchange Live. My name is Paul Hill, and I'm delighted today to be able to speak to an accomplished small cap fund manager, Will Tamworth of Artemis. So, welcome, Will.
Thank you very much, Paul. I'm delighted to be here.
Yeah, well, it's great to have you on the show. Now, we've had a ton of sort of key macro and corporate news over the past couple of weeks, not least the Federal Reserve dropping interest rates by 0.5% last week. But before we sort of run through your outlook for the rest of the years and for equities, I don't suppose you could just quickly remind the audience what kind of investor you are, what kind of stocks you like.
Of course. Mark and I run a UK small cap fund. We're looking for companies that are leaders in their niches with strong balance sheets and ones that are making good returns. Now, that's quite similar to what lots of other people would say. So kind of where are the differences? I would say three things. Firstly, we're more value focused than many of our peer groups. So we really care about how much we pay for a business. Secondly, we're very cash flow focused. And thirdly, we take a long-term view, by which I mean a sort of 3 to 5 year view. And the reason those things are important, the value focus, quite simply because long-term value has outperformed, not by a little bit in small cap, but by an enormous amount. So long-term, you make better returns from having that valuation discipline. The cash flow focus, because it helps to reduce the number of problems we have, the number of blow-ups that we're exposed to. And the long term, because it significantly increases our opportunity set. We're not limited to just the companies where we can see an obvious catalyst in the next 3 months, 6 months, 12 months. And indeed, actually, catalysts slightly put us off companies in many cases. And I suppose bringing that together, you can see as an illustration of that, the fund is trading on about a P of 12.5. It's growing about 9%. The average holding period is 6 years, and the free cash flow yield is about 8%. So kind of demonstrating some of those traits I talked about.
Yeah. Well, I was looking through some of your stocks in the portfolio, and quite a lot of them are sort of tech orientated or healthcare orientated. So you must have a sort of a system whereby you can overlay sort of strong growth onto it, because some of the valuations have now sort of moved on a bit, but they're obviously great companies. How do you play that into the sort of the value tilt? Because obviously you've picked some really good, strong winners here.
Well, you're very kind to say so, but no, I would say, look, we like growth. There's nothing wrong with growth whatsoever. Growth is obviously it's a positive trait. We're just cautious to how much we'll pay for that, and we found during the sort of 2020 period and sort of even sort of 2018, 2019, we felt that growth premium was being so stretched that we were struggling to own those companies. Now, more recently, some of those companies have come back into valuations that we are more comfortable with. So it's a balance.
Good. Okay, well, we've got through those stocks. We'll run through. If anybody wants to ask Will a question, please put them into the chat bot, and I'll read them out. And now, Will, just in terms of that strategy, then, how's the performance of the Artemis Fund been over the last couple of years, and also importantly, how do you think, or how are you looking at things going forward?
Yeah, so the fund's actually been performing reasonably well over the last year or so. To the end of August, we were up about 18%. We've given up some of that in September, but up sort of 14 or so percent year to date. And the relative performance over the last few years has been quite positive. As far as the outlook goes, look, we're really excited about the opportunity at the moment. We feel the reasons not to own the UK are gradually being ticked off. So political instability, or we've got a government for the next 5 years now. Fears about recession, fears about inflation. Inflation's now back at target. Real incomes have been rising. If you look at the ASDM income tracker, by 10% or more for the last 3 months. So just a number of no negatives being ticked off. And the valuation of the UK market only makes sense if you believe this negative narrative. And I think it's getting harder and harder to sustain that negative narrative. So look, we are positive, and I would say that there are other indications that other people are positive too. And two, I'd cite first of all takeovers. So we've had over 30 takeovers in the fund over the last 5 years at an average premium of very nearly 50%. Now that tells you the traits we like are attractive to others. It tells you that valuations are wrong, not by a little bit, but by a huge amount. And it tells you that someone else is taking a more positive outlook on these companies than the public markets are. And the second thing I'd highlight is the level of buybacks we're seeing. So, as I said at the beginning, Mark and I run a UK smaller companies fund, and buybacks are not something you think about with regards to UK smaller companies, or at least historically haven't been. But we've got more companies buying back their shares today than at any point. I mean, certainly as long as I can remember, but I'm not sure there've ever been more within the UK small cap universe. We've got about a dozen companies buying back their shares. And again, I think that tells you that balance sheets are strong. So on average, the median company is forecast to have no debt in the fund. It tells you that managements are more optimistic about their company's futures than the market is. And it also tells you they think their shares are cheap. I was chatting to the CEO of Fuller's recently, Simon, and he was saying, why would I buy pubs in the open market when I have to pay full value for those, when I can buy back my shares, and effectively I'm buying back those pubs that I know best and that I've invested in for half price. I thought that illustrates that point quite well.
Mm-hmm. One sort of like tick in the box which hasn't yet happened, or doesn't seem to, is the fund redemptions in the sort of small cap. How are you seeing that and sort of panning out? Because we're all hoping that at some point in time there will be a move, more money into sort of like, small caps, into the fund managers, etc. But so far it doesn't seem to have really transmitted through the stats anyway.
So I'd say a year ago there was no interest whatsoever. There is now definitely interest. I'm not sure it's necessarily translating to flows yet, although the fund has had positive inflows this year. So year to date we've had some money in, not enormous amounts, but it's positive, not negative. But the number of meetings we've had has stepped up significantly, and the number of inbound requests to see us has stepped up significantly. So I think that the stars are starting to align, but we're not quite there yet.
Yeah, well, that'll be a major boost. There's no doubt about it. Because I mean, as you rightly say, there's a huge, big valuation gap between intrinsic worth and what the market capitalization is of a lot of these sort of small stocks. Okay, let's move on to one which has done really well for you, and it was a very good deep value growth stock. It's Beeks Financial, which basically does IT effectively networking infrastructure for the capital markets. It puts its servers next to big exchanges to help its clients like fund managers, high frequency traders connect to the exchanges very quickly. And more so just recently, it's now won 3 large exchanges, one with the Joburg, which has now extended its contracts. And then it does seem as though it's just inked a deal with NASDAQ as well. And the race and the shares have raced ahead. So they're not cheap now, but the growth is going to be literally electric. So how do you sort of like look at it and the future ahead for Beeks?
Yeah, so Paul, you've picked on, I think, probably the most expensive company in the portfolio today. So as you say, it does, rather than as a fund manager, you having to place your own server in the data center of an exchange, you can effectively purchase a pre-programmed, pre-configured on the cloud, sort of ready, oven-ready solution from Beeks. And what we were attracted to initially is this is very sticky recurring earnings. The business was growing strongly even before the contract announcements that you've talked about, and at a very high gross margin. So as you grow strongly, if you've got a high gross margin, then that drops through to strong cash generation, which is the thing that really excites us. Now, they haven't specifically announced which global exchange they've won recently, but you can see from SEC filings which one it is. And to give you some context of how big that could be, over time, and this takes time to build, it could be worth perhaps 100 racks of space at, let's say, $250,000 per rack at a 50 to 60% drop through margin, which would be worth about £10 million or so of profit compared to the 4 million or so that's forecast for this year. That's just from one contract. So the reason we haven't sold any shares yet is because we've had these very, very positive announcements, but because the company doesn't yet know how quickly those will build, the forecasts haven't yet moved. So it looks very expensive on consensus valuation, but the consensus hasn't moved to reflect these forecasts, these contract wins.
Yeah. So basically, you're expecting it to, or there's a good chance anyway, to beat, at least to meet anyway, but to beat expectations going forward. And the growth rate is must be a very strong double digit. So if you look at it on a PE and then on a PEG ratio, actually your PEG ratio is probably, I don't know, not much more than 1, I guess.
I think that's fair, and I'm not saying they're going to be upgrades this year, but looking again, I said at the beginning, 3 to 5 year outlook. It's that sort of time frame where you can still get quite excited.
Yeah. Well done on that one. You're too modest, you are, on that one, because you started by saying you picked the most expensive. I'd say it's one. You've done a fantastic winner there, so I wouldn't apologise for doing very well on that one. Okay, let's move to really the poster child of Forex and international payments in the UK, Alpha FX. I think it's Alpha Group now, and it's sort of like run by Milton Tilbrook, I think, the CEO and founder there, and he's decided to step down. So the shares, unfortunately, dropped a bit last week, but they're still doing. The business is still knocking the ball out. What's your latest views on Alpha FX?
Yes, so it's Morgan who's the outgoing CEO and founder. Look, so this is one we bought it at IPO. A few years ago, I think it just under £2. We sold it at £5, thinking we'd been very clever, and then we actually bought it back at £20 a few years later. So kind of just illustrating quite how wrong.
You didn't do bad. You made 150% originally, so
we should have held it. But it's an illustration of the valuation discipline kicking in. What's changed between when we sold it at £5 and when we bought back into it? Principally, they've built up an alternative banking business where they are sitting on about 2 billion of client cash, and that client cash earns interest rates of 4 or so %. Now, there are lots of businesses that benefit from client cash, the investment platforms as an example. This is the only business I can think of where they strip out those earnings as non-underlying earnings, so that they're not in the adjusted earnings, which means that on a headline basis, the shares look quite expensive. But this is real cash flow. So 2 billion at 4% interest rates, that's 80 million or so of free cash flow that they earn. So we were re-attracted by this very, very strong cash flow position, which meant that we were able to buy a company which is delivering very strong growth, but actually an attractive free cash flow yield because of this kind of hidden value, I suppose.
And do you have any importance on the sort of the CEO and the fund? Because obviously, Milton is Morgan is obviously man and boy in the business, and is probably pretty essential to it. Obviously, deciding to step down, and I guess that's what people will sort of like short term worried about.
So when we first met the business before IPO, we went to see them in Reading, and it's a completely unique culture. I came out thinking these guys they've got something. They could sell anything. They happen to be selling a slightly unexciting FX hedging program. So absolutely not sex of violence, trying to make your cash flows as a company more predictable. But their competing FX brokers were out in the pub on Thursday night. They were doing circuits classes. It was just a very, very different mindset. And that is Morgan. That's Morgan's energy, Morgan's drive. The business has grown enormously from that point. They were kind of one office in Reading, and they're now offices all around the world. And he feels he is no longer the right person to take on the business from this point. And to give you an illustration of his confidence, he's put an extra £500,000 of his own money to buy extra shares after the announcement. And the incoming CEO, who, by the way, has got a track record of scaling businesses elsewhere, has bought £1.5 million worth of shares. So that's something that we keep an eye on. We're actually seeing them later today. But that putting your money where behind your company, that means a lot to us.
How do you factor that into the sort of the valuation, where the CEO and founder has got the X factor, which there aren't that many around, of people who are so, so involved in the business, so charismatic, and can see opportunities that not many others can. It's the classic Jeff Bezos, the Elon Musks, these kind of guys. But Morgan is pretty much up there, actually. He's not quite, but he's in the UK small cap. He's done a fab job.
He's done an incredible job. I think he's 41, and he's built a £1 billion business where he's got a more than 15% stake. So he's done incredibly well. I think that one of the reasons we like small caps is because the drive and the passion that you get from CEOs is so important to the businesses. It's, people work harder because it's their lifeblood. It's their it's their baby, or however you want to describe it. And I think that's really important. We tend not to follow star CEOs. That's not how we think about it. But identifying people who have got a significant amount of their money tied up in the business and who are passionate about it, that's really important. And I think that's a reason behind. We talk about the small cap effect, where small caps outperform 3 to 4% a year over the long term. I think that passion and that drive is part of that.
Yeah, no, I would agree. I'm an investor myself in small caps, and the thing I always look for is hunger and soul in the game, not just skin in the game, but soul in the game. And if that's the case, and I like the business model, then he gets a tick in the box, because I think they're the captain of the ship is by far and away probably the biggest, sort of differentiator for a small business, which has to maximize the resources that it does have. Okay, we've got a question coming in from Javen Turner, and I don't know whether you own this one, Will, or have had a look at it. It's sort of like a controversial stock, or so we say. It's got a number of opinions. Alphawave IP Group apparently has just dropped a bombshell this morning. Shares down 31%. I've not seen it, but it must be a trading update, etc. I don't know. They basically do microchip design for high performance and accelerated computing, and clearly, I think they've probably had some lumpy orders where, I don't know, I'd read it, but that'd be my take. I don't know if you've ever had a look at this sector, or whether you could say anything at all.
I'm sorry, I'm gonna have to pass on.
Yeah, no problems.
I don't.
That's easy. That's easy peasy. That's good. Okay, well, I'm sorry about that, Javen, but I would say, this whole set area of silicon chips, etc. design, then there's some clear winners, but they come with big contracts, and if some of them haven't landed at times, then you can get a profit warning. But anyway, let's wait and see. Okay, good. Let's move to a real good turnaround, which is a real sort of like feature, I think, of your portfolio for value investing, is NCC, which went through its own problems. It's a sort of like a cybersecurity kind of stock. Got two divisions. One as a consultant in cybersecurity, which went through a bit of a transition about 2 years ago, a bit of a reset, and also it's got a very high cash generative software escrow business that helps corporates recover their systems, and to make sure that they have all their IT systems if somebody goes, if a developer goes bust, etc. Now, I'm guessing they've done really well, and I'm guessing they're continuing to do well from the likes of CrowdStrike. But what's your sort of like the thesis on NCC now? Because it's doubled from its lows, actually, I think.
So as you say, two businesses. It's actually the kind of less exciting escrow business that we are particularly attracted to. So the escrow business is the market leader, global market leader, as you say, in effectively giving companies insurance against their software providers going bust. Now, it's not growing very fast. It's been growing low single digits for the last few years, but it's very high margin and it's extremely cash generative. And it's been slightly the unloved part of NCC over the last few years. But actually, if you look at it, it's the business that generates all the cash flow. And it's done that whilst being the unloved party of the two. So that's the business that attracts us. Within the cyber business, this is effectively, it's a people business, almost like a consultancy business. You're selling people. So it's all about making sure you've got the right cost base, and that's the mix of low cost people overseas in say Manila and onshore people, and then making sure you utilize those people at a sufficiently high rate. And this is a business that saw very strong demand in the sort of COVID period, and then a softening in demand from the big tech customers more recently. And that's the bit that's had to be restructured. Now, the good thing about these businesses is you can manage them so you get the utilization back on track. And I think we've just started to see that. So you've seen a recovery started to come through there, but with a lot more, I would say, still to go.
How much of that consultancy is recurring revenue streams? Because obviously most of the escrow is just pure sort of like ongoing contracts, annualized ARR. But how much of the consultancy is that all project related largely?
So it's lots of repeat customers, but not much contractually recurring earnings. So it's the same customers year in, year out, but the level of activity can fluctuate up and down. So it's not the same quality of revenues that you've got in escrow, but it should be capable of growing at double digits, which escrow is not capable of doing.
Yeah, well, you've done pretty well out of the shares. There's no doubt about it. Okay, let's move to another one in that sector. We've got GB Group, which again, about 3 years. Well, during the first lockdowns in the pandemic, it did really well because it does online ID theft, which is obviously all the e-commerce protection of people selling to consumers to make sure they are valid, and it also does sort of location software and fraud prevention for all that. So it's in the sort of like the cyber security, did brilliant well in the lockdowns, and then I think it bought a business actually in the States that I think it had a crypto problem, didn't it? Basically, because did a lot of work on crypto, and then crypto fell a bit, and therefore it lost a bit of volume. But the shares have now started to sort of recover. What's the sort of the thesis here now? Because it should be a winner in the generative AI world, you would have thought, with so many people trying to be an imposter for real people trying to buy stuff online.
Yes, so this is a business that Mark bought well before I joined Artemis. So kind of had it for a decade or so, and it's grown for a long period, sort of double-digit organic growth at 20 or so % margins, and then it's supplemented that organic growth through acquisition. So it's been an amazing long-term success story. We sold out of it in 2020. We felt the valuation had got too rich. It had been typically kind of low 20s P or kind of just under 5% free cash flow yield, and then suddenly it went up to 50 times P. I think unfortunately we sold it before the top.
But you still did pretty well though.
The rating got too stretched. As you say, they then bought Accurant in the US, and they paid a sort of eye-watering multiple. I can't remember exactly what the multiple was, at a time when the whole business was benefiting from a huge shift online because of COVID. Kind of fast forward to where we are today, we bought back into the shares in 2022 when the sort of COVID excesses had started to unwind, and the shares had got to a much more reasonable valuation. And to put it in context now, it's on about a 6% free cash flow yield. Now, this is a business that's still capable of delivering double-digit organic growth at a 20 or so % margin on a 6% free cash flow. That looks really, really interesting to me. It's not the kind of anything like the rating it was on previously. So I think we're working through the hangover of one of the beneficiaries of that strange COVID period that we all worked through.
Yeah, and I'm guessing they also had, I think if I remember rightly, private equity interest about 2 years ago. Is it somebody from the US? In fact, I think if I remember rightly, I think that was the spike here actually, if I recall it, about that sort of level. So you never know. I mean, there's so many big IT sort of specialist private equity roll-ups in cybersecurity. You wouldn't be surprised if somebody else put a number on these guys.
So I think there was an approach. I'm not sure how kind of developed it was, but I would say so that they are a market leader in various of their niches, and you talked about kind of the basis of what they're doing, but they do face quite a lot of competition in different markets, often from companies that are private equity owned, that are not profitable, not cash generative, and that have been able to fund themselves with very, very low cost capital. And I'd say one of the benefits of the last year or so is that capital now does have a cost. So the competition's, the wings have been clipped a bit, I would say.
Yeah. Okay, good. Well, we had a question on over the weekend, and I can't. I'm just trying to recall who it was from. It was anyway from a guy, and he was asking about Pressure Technologies, which is basically an engineering business, small cap. I'm not sure exactly where it's based. It's got two divisions: a precision machine components division that's been sold off, which serves the oil and gas area. They were hoping to complete on a sale in August, and then they sort of like looked at that looks like it's going to complete in now this month or maybe early next month. And then they've got this core Chesterfield cylinders business that it sort of like helps the defence submarines operation. They've got a bridging loan from their largest two investors, which is I think Richard Staveley at Rockwood, and they've also got, I can't remember the other guy, but they've got one which hopefully will get repaid back with the proceeds. I don't know whether you've ever had a look at this one. It's one of those stocks that could suddenly do really well if it gets the right result, but I guess people are sort of waiting and seeing. I don't know whether you've had a look at this one, Will.
So I'm out of date on it, I would say.
Yeah.
We have owned shares in it in the past. We sold them probably 3 or 4 years ago, so quite a while back. It's had quite a checkered history. The debt's been a kind of a bit of an issue, and it is quite lumpy in terms of the Dreadnought contract, particularly. They are very lumpy. Those contracts, so it's not one that's for us. So yeah, I'm a bit out of date on it. But
yeah, sorry, I didn't. The question came from actually a guy called Mr. Corn. So sorry about that, Mr. Corn. But anyway, okay, let's move on. We've got Serco, which is a different sector. It's into sort of like outsourcing for the public sector. Actually, it does a lot of sort of contracting for the likes of Defence, Ministry of Justice, and also for other sort of like, public services and stuff. Went through a real problem about 10 years ago, I think, in terms of had a lot of fixed rate contracts, really struggled with its debt, etc. But now seems to have been turned around, far more cash generative. Shares have done really well. So the question is really, how do you see it going forward, particularly in light of the new Labour government, and because they've made sort of noises that are going to nail consultants and third-party providers and stuff. But let's be clear about it. A lot of the public services need a lot of help. So how are you sort of seeing Serco going forward?
Yeah. So Paul, you're absolutely right. It's a business that had some serious issues under the previous CEO, and then Rupert Soames and Angus came in and fixed the business. And actually, I remember meeting the two of them for about 5 years, and we didn't invest because the cash flow still wasn't coming through. And then we bought a holding 3 or 4 years ago, just as the cash flow started to come through. And it's now on a 9% free cash flow yield. It's got a strong balance sheet. They're buying back shares every year. So it's in a completely different place to how the business was a few years ago. With regards to the Labour government, I suppose to make a couple of observations. Firstly, this is no longer a UK business; it's a global business. They've got a big American business. They've got a big business in Australia, in the Middle East. So it's much more global than it was. Secondly, if you look at the when the outsourcing companies really did well, it was under the new Labour government previously. That's when the sector was kind of, if not born, but certainly became established. So a Labour government is not necessarily a bad thing for outsourcers. And you're absolutely right that governments across the world are under pressure to do more with less, and outsourcing is part of the toolkit to enable you to do that. So I'm not saying that tight budgets is automatically a positive, but it's not necessarily a negative, because you need to do more with less.
Yeah, you're right, actually. Under the Brown, Blair government, etc., that was when they sort of really pushed basically the private financing initiatives, didn't they? The PFIs. And I know they've talked about doing it the same, because that was a real boost to essentially joint mutual benefit between the private sector and the government, wasn't it? So that's probably how they might do it going forward, if they want to take the heavy lifting off the government's balance sheet, if they can.
Yeah, it will be called something different, but
yes, exactly. Yeah,
I'm surprised if you get something along those lines.
Okay, let's move to another real sort of like a bit of a storming share here. It's Warpaint, and sort of affordable cosmetics, absolutely done brilliantly. And I think the founder's still there, selling in the UK, Europe. And I think what really sort of stands out is that it seems to be knocking the ball out of the park across all its products and all its regions. So what's your sort of the latest investment thesis on this one? The shares, again, have just done absolutely brilliant. They're not that cheap, but actually on a PEG ratio, I haven't looked at it exactly, but it's probably not that expensive either. So how are you sort of sizing it up?
So yeah, the shares are on about a 20 times PE or 4%. Free cash flow yield, something like that. It reminds me a bit of Fever Tree when they floated, actually, in that it's growing strongly in all geographies across all their main brands, both online and offline. So it's rare to see that sort of momentum within a business, and they are just scratching the surface with a number of their potential big customers. So I saw them recently. We're talking about Superdrug and Boots in the UK. I'm talking about Walmart in the US, and they're in a tiny fraction of the stores that they could potentially be in with those customers. And even when they are in the stores, they're offering a small subset of their total product base. So enormous growth potential. To kind of balance that a bit, we need to be mindful. This is a business with relatively low visibility. They don't know what their future demand is going to be. So we need to kind of have that degree of caution. But it is rare to see a business with such strong momentum across so many different markets and segments.
And their turnover is about 105 million is forecast. Can they scale? Have they got the infrastructure and the distribution and the stock management systems, the ERPs, to be able to get this to a £300-400 million business? Because that's always something at the back of my mind, is when you have such a successful brand that really is chiming with consumers, you can overtrade if you're not careful. You can lose sight of your stocks, particularly where you get lots of customers, retailers actually want your stock it, but there is particularly over, say, Christmas, a return of stock as well back to suppliers if they don't sell through because they don't meet the requirements. How do you view that risk? So scaling a brand that is obviously physical but very emotional in connection, and you've actually got the systems in place that the wheels don't fall off the truck.
Yeah, so this is there is a degree of fashion in this product, and that comes with risk because of things go in and out of favor. So there's definitely risk there. From an ability to scale, it's largely an outsourced business model. They have a number of different factories that produce the product in China. They don't own those factories, so that increases their ability to scale up and down. And they are very, very focused on cash flow and very focused on stock. So you're absolutely right. These are kind of the right questions to be asking, but it's something that they're focused on. But this isn't the highest quality business in the world, but it has it's well run and it's growing very, very strongly.
Yeah, no, I mean, well, hey, when you say it's not the highest quality business, you're a hard man to please there, Will, because the shares have gone from 80p to over £5. So I wish anyway, that's it was done really well out of it. Okay, let's move again to sectors. We've got Future Group, which basically advertising a business. Owes Go Compare as well, the price comparison website. Was a darling under the previous CEO about 3 years ago, then went through a few sort of like problems, a couple of profit warnings. And now actually seems to be turning a bit of a corner. I think the momentum has now started to build a bit more from Q1 to Q2. Again, sort of like, how are you viewing it going forward? Because it really has been a bit of a roller coaster for investors if you look at it over the last 3 years, Future.
Look, absolutely, it has been. So it's another company actually that was a big beneficiary from everything being shifted online during COVID, and then again the hangover as that unwinds. There's a kind of double whammy here, because a lot of Future's historic growth was driven by acquiring businesses on low multiples whilst being able to issue shares on a high multiple. Now, as the shares have been hugely derated, their ability to do that has been taken away from them. So it's very much an organic focus. The shares got to a crazy valuation. I think partly the COVID unwind, but also concerns about AI at the same time that was going on. But even post the recent bounce, the shares are on I think about a 12% free cash flow yield. The balance sheet's solid, and there are signs that it's returning to positive organic growth. I think they've got an update later this week actually, so we'll get more evidence of that in the next few days. But a 12% free cash flow yield for a business that is growing is extremely generous.
Yeah, looking at the PE of 8, and I think probably if they ever needed some money, they could if they ever wanted to sell Go Compare, which I don't think they do, because that's a sort of like a bit of a crown jewel, but that would realize a lot of money, because I think, as you say, it generates so much cash, doesn't it? So
and even through the period when they were being very acquisitive, the cash generation was always very good. So we tend to be quite skeptical about roll-up businesses, and often it's all hidden. All the cash flow gets lost in exceptionals and restructuring charges, and you can't really see what's going on underneath it all. With Future, the cash flow was strong throughout that acquisitive period.
Yeah, and in terms of how do you see a business like this sort of like either benefiting or getting impacted by generative AI going forward? Because obviously, if it's sort of like, Gemini now is search discovery or internet discovery comes out with an answer, albeit they do still put links on it. How are you sort of seeing that one going forward? It's a difficult one, obviously.
It is difficult. Ultimately, AI isn't testing the product, so you still need take Tech Radar as an example, one of their biggest brands. They're writing reviews on all sorts of different products, and then they make money when people click through the link saying, I want to buy the latest iPhone, and they make money when you click through one of their links. You still need, in an AI world, you still need trustworthy content that the AI can leverage, and I'm skeptical that gets totally disintermediated. I think the need for trustworthy content actually goes up when there's more content that's being produced by generative AI.
Yeah, and as I say, I think a lot of bad news has already been priced in, even if it is impacted. Okay, similar business actually in price comparison is Moneysupermarket.com, which again did brilliantly during the cost of living crisis about 2 years ago. And the shares have sort of fallen back a bit from that. I guess probably people are worried again a bit about generative AI, but they have a lot of different moving parts across divisions. Like travel has obviously done well for them. Money comparison has done well for them. Energy's now starting to come back. So how are you seeing this one? It's not expensive either, this one.
It's quite the opposite. I think it's on about a 9% free cash flow yield. It should end this year with no debt or no net debt at all. So yeah, very strong cash flow, very strong balance sheet. The key thing for me on this one is the ability to move away from relying on Google or the latest Judi Dench advertising campaign to drive business, and to try and get away from, you switch your car insurance perhaps every couple of years. By the time you switch, you've forgotten who you switched with last time. It was 2 years ago. So you need that prompt from a singing meerkat or Judi Dench or whatever it is to force you onto the specific price comparison brand. Now, what they're doing, I think that's interesting and different. Two things. One, Martin Lewis through Money Savings Expert. That's a very, very valuable source of traffic, which Moneysupermarket owns.
Yeah.
And also the Super Save Club, which has grown from nothing to, I think it's 200,000 customers in the last 4 months, and they're talking about millions of customers. And the idea is you have those customers are on an app, and they are repeat customers. They're incentivized to switch multiple services, which other price comparisons companies can't do because they haven't got the breadth of offering that Moneysupermarket has as the market leader. And it means you become less reliant on Google to pay for the customers, or less reliant on the advertising campaigns. So I think that transition over that 3 to 5 years could be really interesting. In the short term, I think it's more concerned that because car insurance prices have risen so much over the last few years, the fear is that's driven a boom in switching, which then gets hard to sustain. Now, I'm a bit more skeptical on that. I think if insurance prices are high, even if they're not rising, if you can make a material saving from switching, you're likely to try and do that. So I think the business is still well placed, but that's, I think, what's driven the sell-off that you can see recently.
Yeah. No, my wife would agree with you, Will, because every 12 months she's on Moneysupermarket looking for bargains on house insurance, car insurance, and travel insurance, not just for her but for her mum and the rest of the family. So it's her go-to website price comparison, regardless of what else is on. That's for sure. Okay, let's move to we got another consumer stock online, Moonpig, which I think was listed during the sort of the 2020 or 2021, bit of a darling, and then it got sold off a bit, but now seems to have sort of stabilized. It does sort of like customized online greetings cards in the UK, which is where it's made its name. Moved out, done the similar sort of thing in in Europe. And also offering now lots of other adjacent products like gifts and flowers and champagne and all kinds of different experiences. How are you seeing this one going forward in the sort of the gift and consumer environment?
So it's interesting. You Paul, you seem to have sort of picked on some of the kind of COVID winners, and then they've become.
Well, fallen angels are quite interesting because if they've dropped so bad because of sentiments, but actually there's the fundamentals long term are still. I remember when I was in 2003 looking at Amazon after the .com crash, it was at $12. And look at it now; it's about 3,000. So it can be quite fruitful for stock picking fallen angels.
So we met them at IPO. We didn't invest then. We felt it was being floated with expectations that looked quite stretching, particularly given this COVID tailwind, which was never going to persist. We bought the shares after, I think they'd fallen 40% or so from the IPO price. We were still a bit early, actually, when we bought them. But what we like about this one, it's a market leader. It's about 4 times the size of their next biggest competitor for online cards, Funky Pigeon. And that market leading position means they have really, really good data. So if you buy a birthday card in Tesco's don't know who it's for, or they don't know anything about it. Whereas you buy a Moonpig, they collect lots of information. They know who it's for. They know whether you've bought a card for that person in the past. They can send a reminder to you next year. They can build up this data, which shifts the purchase of the card from a one-off low quality transaction to potentially a recurring earning stream. And then if you add on to that the ability to upsell additional products. And this is an area I don't think they've got quite right yet. I think they need to improve the recommendations for flowers or champagne or experiences. But given that you have better data than anyone else, the ability to upsell should be there. And that's that virtuous circle you get of having everyone on your own app. So you're not paying for the customers, and then you can upsell to those customers and turn it into a sort of recurring earning stream. I think that's quite interesting.
Yeah. Do they ever do this type of service for other brands to allow them to run off the same rails? I know it's all Moonpig, etc. But because they've got, I mean, one of the key differentiators must be the infrastructure to do small sort of like, gifts which are high value in terms of emotion to the individual. So they need to be there on time. So you need the delicacy of the distribution, the sensitivity of the delivery and the receipt and all this sort of stuff and the data. But presumably they could also leverage some of that infrastructure to third parties who have similar sort of like, have got just very good emotional brands. I don't know.
Yeah, so it's interesting. I certainly, one thing that's important, if you're attaching a gift to a card, you want the two things to arrive together and at the same time. You don't want a card to arrive one day and then the gift arrive 3 days later. So therefore, having a facility where you can integrate those two, and they do that in Tamworth facility there. Is important. Now, obviously, you can sell third-party product through that infrastructure. So, card plus, you don't need to own all third-party product, and certainly the experiences, you don't need to own the experiences. But I think that's the key, is having those two things together. I'm not sure they've gone further down the third-party brands than that. But yeah, interesting.
Yeah. No. I mean, it just. That sort of, I mean, just our family, our go-to one is M&S. And, if they wanted to do something that was a bit more imaginative than just a bunch of flowers and a little gift card, then they could do a fuller service to their M&S clients and then effectively Moonpig white label it. But hey, that's just me being asking dumb questions, maybe. Now, let's move to one where it hasn't all gone well, is Next 15, because they're a sort of like a media advertising consultancy business. That serves sort of the public sector, technology companies, digital translation. And they had a bit of a shocker in terms of a large contract they lost a couple of weeks ago, I think, about £80 million of revenue they were going to lose. Anyway, the shares bombed out. But now they're trading at very, very cheap levels. I guess the call is here. Is this a value trap, or is this a value play at these levels? How are you seeing it?
Yeah, no, you're absolutely right. It's been a very poor investment so far, to put it kindly. So specifically on why we're attracted to it. So this is a conglomerate of 18 or so different businesses that are exposed to marketing and tech spend, so sort of digital transformation or technology investment. And we bought into the shares when they were on a double-digit free cash flow yield with a strong balance sheet, knowing there was a substantial contract that had a finite life, which was a material portion of the business, but taking the view that even if you strip that contract out in its entirety, the shares still look cheap. That's how we kind of thought about it. Now, what's happened?
They're cheaper now, though.
So yeah, exactly right. So what happened is that contract we thought had an end date 3 years in the future, and it got terminated 3 years before because there was a break clause in the contract. So it got terminated sooner than we realised was a possibility. And the tech clients, the spending has remained subdued. It's not got any worse, but it's not started to recover. So the profit warning from a couple of weeks ago was those two issues. Now, one of the benefits of having a decentralized model with a number of different brands is what happens at Mac 49, where this contract was, doesn't directly impact the other businesses. So can the other businesses continue to perform as they have done in the past and grow? Yes, they should be able to. In which case, even if you strip that contract out in its entirety, which is what's happened, the shares are on a 12% free cash flow yield, and the balance sheet looks fine. So there are some challenges, and no question about that. But you're looking at a very interesting valuation.
Yeah, it's just over 7 times PE, no doubt about it. Is the balance? You've had a look at the balance sheet, because I know they have a lot of contingent payment liabilities, presumably for Mac. That Mac 49, the business, I'm guessing, which will just strip out anyway. But is the sort of the cash flow of the business when you take that, remove the £80 million contract, is still positive, and strongly so, is it?
Yeah. So the cash generation is very strong. You're absolutely right. So there's a double hit from the Mac 49 contract, which is basically they bought the business on a largely deferred consideration basis, i.e. dependent on future performance. That performance period ran to December this year, December 2024. The contract has been terminated as of January 2025. So we basically had the performance period gets effectively the full benefit of the contract. There's 1 month that you've lost, which means the deferred consideration is vastly more than was expected at the time of the acquisition. Now, not more than we knew when we invested, because we already knew about this contract, but the idea had always been that worst case, the cash flows from the contract would fund the deferred consideration, because it was going to go for another couple of years, and it would have fully paid for itself. Now we've got contract being terminated earlier than we thought. Now there is still, I should have said that there is still the possibility of earning some revenues from this customer. It's a Middle Eastern sovereign wealth fund is the end customer. The company have assumed there are no revenues, but there is a possibility that they will get some revenues from it. But sorry, to directly answer your question, Paul, that even allowing for the deferred consideration, the balance sheet is in a very solid place. So there's not a balance sheet issue in this business.
Yeah, and what's the sort of the likelihood of this one gets bought? Sort of like a sort of bid for, because I remember it tried to bid for M&C Saatchi, didn't it, 2 or 3 years ago, which felt so. There's clearly synergies between similar businesses, advertising expertise, media agencies, this sort of stuff elsewhere. So if the synergy is somewhere on a really low valuation, then it'll probably be in the crosshairs of somebody, I imagine.
Yeah, we owned Kin + Carter, which was taken over 6 months or so ago. I'd be disappointed if that's how this ends up, unless the price is very substantially different to the price that we see today. Because I think there is real recovery potential here, and the valuation, as I say, 12% free cash flow yield is very interesting. So takeover gives you short-term upside potentially, but you need to make sure you're getting at least fair value if you're taking that. Yeah.
Okay. Well, definitely we'll wait and see how that one progresses. And let's move to house building. Obviously, a big topic of debate in the Labour conference this week, with Rachel Reeves promising to build 1.4 million houses over the term, 300,000 a year. One of the beneficiaries of that is MJ Gleeson, that I know you earned, as affordable homes, usually starter homes in the Midlands and the North East. The shares actually, given interest rates shot up after to stop the rising inflation, the shares have recovered strongly over the last 2 years, trade a bit above tangible book now, actually. But how do you see this particular business? I guess it's probably also not going to be affected too much by the cladding either, because it made sort of starter homes.
Yeah, so I think there was a small cladding provision, but it's not material. So there are two businesses. There's the business you referred to, very low cost housing. I think the average selling price is about 180,000, so kind of well below the other listed house builders. And then there's also a land promotion business, principally in the southeast, which is a separate business, basically doing deals with farmers to promote their land, and then sharing in the uplift of the value as you get planning. Similar business to actually a business we also own called Harworth, have a similar business. We think both of those businesses should be relatively well placed in a more stable political and economic backdrop. And this is in the sweet spot of what Labour are trying to do. So if Labour want to build more homes, then this is a company that should benefit. I'd kind of caveat that with, look, it's house building is a relatively cyclical sector, so you have to be cautious. But historically, if you're buying companies on around 1x book, you've tended to do quite well on that basis.
Yeah, no, I would agree. It should be well placed, as long as the government doesn't decide to have windfall taxes on the house builders or remove the valuation uplift between, non-consented, land to when you actually do get planning permission. Then there's a number of levers they can pull, but yeah, they should be really well placed. Okay, let's move to medical. We've got a new one which was listed that people probably haven't ever heard of. It's pronounced AOTI, is it? Basically, they do specialist US company specialist medical devices and treatments for diabetic foot ulcers and stuff like this, and for other sort of like wound care. They've got FDA approval. The business is actually doing pretty well. It's the sales, I was looking at it last, they're already at about nearly $60 million, growing strongly 30% per annum. Can you introduce this business? Because I don't think anybody's really heard of it before. I certainly hadn't until I realised it was in your portfolio.
So it was a recent IPO, IPO'd earlier this summer. So we're kind of very early on in the company's listed track record. And basically what they've got a product that combines oxygen, pressure and humidification to help treat foot ulcers or ulcers, principally in diabetic patients. And the two stats that really kind of stood out to me were there's an 88% reduction in hospitalizations for their for their patients, and a 71% reduction in amputations. So those are stark numbers. That means that from whoever the payer of the healthcare is, there's a significant saving. So there's better outcomes for the patient, and also a saving for the payer. Now, at the moment, vast majority of the revenues are in the US, and 2/3 of the business comes from the Veterans Administration framework. They're just starting to open up Medicaid states. So they've got New York, Arizona, New Jersey, where they're getting Medicaid patients. And then medium term, there's an opportunity both to open up more Medicaid states and also Medicare across the country, which would be a huge accelerant. Now, we saw them recently, and they said, so currently today, 2/3 of the business is VA, Veterans Administration. Within that, we are 3%, roughly 3% penetrated, and that's only 10% of the total US market. So it gives you an idea as to how huge the opportunity potentially is. And they are 80% of this very specific niche that they operate in. So they are a clear market leader in their niche.
Do they sell just on the products? Do they sell? Is it recurring revenue streams, or is it basically like a device that effectively solves the wound and then they return it, or is it actually a treatment, the cream that helps the wound?
It's a device that a patient uses over a period of time.
Okay.
So it takes, let's say, it takes 6 weeks of treatment or something. So there's kind of earnings through that period. But yeah, they need to continue to recruit new patients.
Yeah, I'm guessing the gross margins are pretty high on this as well, probably, aren't they? They tend to be sort of 80% plus, I guess.
Yes, it's absolutely right. So that we're kind of 85% or so gross margin. So if you combine 30% per annum growth with greater than 80% gross margins, you're getting very, very strong cash flows quite quickly. Now, we are early in this. This is a relatively risky, relatively early stage business, but the growth potential, if they get it right, it is substantial.
Well, it's about, I mean, just in dollars, I mean, it's a nearly $190 million market cap company. Well, I was just looking at the chart there. What's the liquidity like in the shares? Because if I wanted to buy some shares, is it a Reg-S share? Is it at the moment? Because it has that 12-month lockup period for stopping US investors from buying those. Because it's listed in the UK. Is that why the liquidity? The chart over there doesn't look as though there's lots of shares traded. I could be wrong.
No, so the free float is small. The founders retained the bulk of the business, which we like. We like that, as we talked about earlier. So it is very liquid. We bought a holding at the IPO, and we haven't bought or sold any shares in the subsequent few months. But we're looking at this as what's the opportunity on a 5-year view? We're not thinking about trading in and out of it. And it's a relatively modest holding in the fund. It's about a 1% holding.
I think it's a great company. I think you've really spotted a nice business there. And I was only asking because if people wanted to buy shares in it, then they might have to sort of battle a bit, because even though it's got quite a large market cap, given the liquidity, they probably can't drop too much money into it at the moment. But no, that's right. And you don't get many high quality medical devices businesses at a good valuation with such strong growth, operating margins, and a huge total addressable market on the market, on AIM very often. But that's right, it's gone right into my stock watch list, that's for sure. Now, another fallen angel, sorry about that, is Alliance Pharma, which is an over-the-counter healthcare products business. There was a darling a few years ago. Shares were knocked back, got a bit of debt it's paying off, also does about 25% of its business's prescriptions. Have you got just a quick few words of how you're viewing this one as a turnaround? Because I'm guessing it's got good pricing power, but probably having to put a bit more marketing into its budgets to really sort of drive that top line growth.
Yes, very strong cash generative business. They have had some issues, as you say, over the last few years. They had a CMA investigation into price fixing over a specific product. They've actually, on appeal, been found not guilty in that. So that's been dropped, but that was an issue. And they bought a business, Amberen, in the US, which has struggled since they bought it. They were delisted for one of the big traditional bricks and mortar retailers in the US. The key product is a product called Kilo Coat, which helps scars heal. That's the biggest product, and it's very high margin. Obviously, being dependent on one product, which this is relatively dependent on one product, that creates risk, and it's largely a Chinese revenue source. They have the US rights as well, but China's the biggest source of revenues for Kilo Coat. The shares got to a extraordinarily low valuation. They're still on kind of low teens or kind of decent double digit free cash flow yield. And the balance sheet sorts itself out quite quickly because it's a very capital light business. So they don't own their own factories. It's an outsourced model for very high return on capital, very cash generative. So they took on some debt to fund acquisitions, and that's been the model for many years. And then they pay off that debt quickly as the cash generation comes through. And we've also had DBay buying close to 30% of the company. So clearly they see something in it as well. So I would say, this is a very cash generative business, which, assuming things come through as we expect them to, the debt comes down very quickly.
Yeah, I mean, 10 times PE, if you compare it to other healthcare OTC products business, they're about 20 times. So there's definitely upside if they can drive that top line growth. Okay, let's move to another really deep value play that a lot of investors have been scratching the head off. It's the UK's biggest pawnbroker, H&T, has also sort of got some shopping, owns its shops, etc., and sells a bit of jewelry and a bit of gold and foreign currency and stuff like that. But the shares are trading at basically less than net tangible assets and on a PE of about 7.5. I can't understand why are they so poorly valued? The H&T, is it sentiment or is it? But how do you see it anyway?
So I think it's there's a degree to which this is self-inflicted, in that I think they let expectations get well ahead of where they should have got to so they had a period 18 months ago when the business was delivering very strong upgrades, and they let people get carried away with expectations, which was unnecessary. They didn't need to. The reason we like it, so they are times bigger than their next biggest competitor within pawnbroking. But it's the adjacent markets which have been decimated from a competitive perspective. So if you're looking for a £500 loan, your doorstep lenders have basically gone out of the market. Your payday lenders have pretty much gone out of the market. Your guarantor loans providers have pretty much gone out of the market. So regulation has driven all the sort of competing sources of that small loan out of the market, or they've driven the cost up so high. With pawnbroking, you've got a secured loan, so it's lower risk, and it's secured against typically a piece of gold jewelry. The customer can't get into a debt spiral, because if worst case they just walk away from the gold ring or whatever it is. So it's much lower risk from a regulatory perspective, and you've got the adjacent markets being much less competitive than they were. So I think it's interesting, but they've recently cut guidance. Still, the business is still growing, but less than they thought. I would say that's largely an own goal. That they let guidance get too far ahead of itself.
Yeah, I mean, I was looking at the net tangible assets. So net assets are what, 416p. The shares are what, 375 at the moment. And you look at it and you just see it's got growth. It's generating cash. There is something that people are worried about, but I know there's a sentiment issue to it. But but I can't see it other than regulation. And as you rightly just point out, it actually should be a low regulatory risk in this business.
I think the other thing that we sometimes hear about is banks don't want to lend to pawnbrokers. There's kind of anti-money laundering concerns, and generally banks are reluctant to lend. I think H&T benefit here from being such a dominant's the wrong word, such a clear market leader, that they're able to have the systems, the processes in place to protect them, and they have got they've got funding secured from their banks. But that might be another area that people ask about.
Yeah, you wouldn't have thought there'd be a risk of money laundering, because they're basically giving people. The risk is that you receive funds from money launderers, not the other way around. But hey ho, wait and see. Okay, if anybody wants to ask Will any final questions, please put them in the chat box. We've got Carcosa. He's basically asking about Supreme at all. I don't know if you've ever looked at this one. It's basically a FMCG business that owns its own brands, but also distributes third party across sort of like vaping is the key one, but sports nutrition, batteries, lighting, and recently bought a soft drinks business, Clearly Drinks, run by a pretty innovative founder, CEO, Sandy Chahar. I don't know if you ever had a look at this one at all. Still reasonably valued, I think, actually.
So again, it's one we've looked at, but not recently. So
not recently. Okay, good. Well, anyway, I mean, it's Carcosa. All I would say on that one, there seems to be the momentum seems to be working pretty well on the business. So let's see how where it goes. Okay, then, Will. Thanks very much. Just some final thoughts, sort of like for investors looking ahead for the next year. You sound reasonably positive, very modest actually. So hopefully, well, you've probably set the bar lower, and then you're going to beat it, aren't you?
I think the outlook for the UK is much better than is widely perceived, and then within that, we know that when UK equities do well, small caps tend to do better than that, and even small flows into the asset class as a whole could lead to quite significant price corrections. So we're very, very excited about the opportunity we see.
Yeah. Good. Okay. Well, I think you're probably right as well. So thanks again, Will, and look forward in base in probably about 6 months' time. So thanks again.
Thanks, Paul. Thank you very much.